Overview of the cost of capital. The cost of capital represents the minimum rate of return that investors require for providing capital to a company. It serves as a critical benchmark for investment decisions, valuation, capital budgeting, and performance measurement. A firm's overall cost of capital reflects the weighted average cost of its financing sources, including debt, preferred stock, and common equity. Because investors demand compensation for risk, companies with greater business risk, financial leverage, or operating uncertainty generally face higher capital costs. Understanding the factors that influence the cost of capital is essential because it directly affects project evaluation, enterprise value, capital structure decisions, and long-term shareholder wealth creation. Factors affecting the cost of capital. Several factors influence a company's cost of capital. Macroeconomic conditions such as interest rates, inflation expectations, economic growth, and capital market liquidity affect the required return demanded by investors. Firm-specific factors include business risk, operating leverage, financial leverage, profitability, earning stability, and growth opportunities. Industry characteristics also play an important role because some sectors inherently face greater uncertainty than others. In addition, corporate governance quality, country risk, regulatory environments, and ESG considerations may influence investor perceptions of risk. As perceived risk increases, investors require higher expected returns, leading to a higher cost of capital and a lower present value of future cash flows. Understanding the cost of debt. The cost of debt represents the return required by lenders and bondholders who provide financing to the company. It is typically estimated using the yield to maturity on existing debt, current borrowing rates for similar debt instruments, or market yields on comparable bonds. The cost of debt is influenced by prevailing interest rates, the company's credit quality, debt maturity, collateral, covenant protections, and overall market conditions. Because interest payments are generally tax-deductible, analysts often use the after-tax cost of debt when calculating the weighted average cost of capital. Consequently, debt financing is usually less expensive than equity financing from the firm's perspective. Equity risk premium and its significance. The equity risk premium, ERP, is the additional return investors require for investing in equities rather than risk-free securities. It reflects compensation for bearing the uncertainty and volatility associated with stock market investments. ERP is a fundamental component of cost of equity estimation and valuation models. The premium varies across markets and over time depending on investor risk preferences, economic conditions, market sentiment, and expectations regarding future growth. Because equities generally exhibit greater risk than government bonds, investors demand a positive ERP. Changes in the equity risk premium can significantly affect asset valuations, required returns, and investment decision-making processes. Estimating the cost of equity. The cost of equity represents the return required by shareholders and is commonly estimated using the Capital Asset Pricing Model, CAPM. Under CAPM, the cost of equity equals the risk-free rate plus beta multiplied by the equity risk premium. The risk-free rate reflects compensation for the time value of money, beta measures systematic risk relative to the market, and ERP captures the reward for bearing market risk. A company with a higher beta is considered more sensitive to market movements and therefore requires a higher expected return. Analysts may also use alternative approaches such as dividend discount models or bond yield plus risk premium methods when estimating the cost of equity. Analytical implications for valuation and capital budgeting. The cost of debt, cost of equity, and overall cost of capital are fundamental inputs in valuation and investment analysis. These measures are used to discount future cash flows, evaluate capital projects, estimate enterprise value, and assess financial performance. Small changes in the cost of capital can have a substantial impact on valuation outcomes because discount rates influence the present value of expected cash flows. Analysts must therefore carefully evaluate assumptions regarding interest rates, equity risk premiums, beta estimates, and company-specific risks. For CFA candidates, understanding the drivers of debt and equity costs provides a foundation for capital budgeting, valuation modeling, portfolio management, and corporate finance decision-making.